Thanks very much, Mark. It's great to be with you all. So Charles Casey from Solaris. We're based up in Brisbane. We're an Aussie equities fund manager. As a quick overview, we are style agnostic. So we invest across the market where we're seeing the best opportunities, whether they're more traditional value areas of the market or more traditional growth areas of the market. We have our three funds at Solaris, our core fund, which has outperformed in 17 out of the past 23 years. Our long short fund, our 130-30 long short fund, which has delivered a great outcome since inception in 2017. And our income fund, which I'm talking about today, which has delivered 8.7% income. That's a gross yield since inception in 2016. But before I start, I've got a bit of a confession to make. I've been running on about 2 hours sleep. And that's because of this little one. Tom Casey, welcome to the family 2 weeks ago. And as any parent in the crowd knows, that first couple of weeks is pretty hectic. And I came into the office and said, I feel like I've aged about 20 years overnight. My colleague Bernard thought it would be funny to put it into ChatGPT to see what the artificial intelligence algorithms think I'll look like in 20 years' time. And it's actually pretty hilarious, so I thought I'd share it today. So the algorithms are not kind, a lot more wrinkles, a lot more grey hair. But in all seriousness, today I'm here to talk about our income fund, and in 20 years' time I'm going to be closer to the age of 65. I'm going to be thinking about what does my retirement journey mean for me? How can I generate regular income? How can I maximise the value of franking here in Australia? And I'm going to be looking to grow that capital throughout my retirement years. Potentially a 5, 10, 15, hopefully a 20-year retirement journey, instead of selling away bits of the portfolio and being left with nothing at the end. So today, I'll touch on 3 key topics: why equities, dividend traps, and why active management is key, particularly in this current market, and the Solaris approach, income with a focus on capital growth. So to start with, why equities? I thought with all this macro noise, it'd be really important to take a step back. And if we go back to 1900, I flew in this morning from Brisbane. I looked down at the harbour, and in 1900, there's no Sydney Harbour Bridge. There's no Opera House. There's horses probably going up and down George Street. It's a long time ago. If we'd put $100 into cash, that'd be worth only $198 after taking into account inflation over this long time. If we'd put it into government bonds, $684, not much better over that long journey. But Aussie shares, it's a remarkable outcome, $287,300. And this is after taking into account inflation, after taking into account 2 world wars, a Great Depression, high inflationary periods, low inflationary periods, a pandemic, a financial crisis. It speaks to why productive Australian companies that can reinvest and grow their earnings and grow their capital are a really powerful asset class over longer term periods of time. But that's not it. Franking credits are really powerful in Australia, and we all know that. We're very focused on that in our income setting. And pensioners, retirees, zero tax rate investors have got this added layer of benefit without doing anything. It's an advantage over passive Aussie equity investors that they can harvest this franking benefit without any additional effort. So we're focused on the income and specifically the franking. So Aussie equities are a great asset class. Franking's powerful. Isn't it easy? Why don't you just go out and buy the highest dividend yielding Aussie stocks? For a long period of time, we've had low cash rates, we've had government stimulus, and it's supported even really low quality businesses throughout this last 15-year window. You know, I take a step back to the homework example and think about, it's like giving a child a gold star for their homework, even if they got the answers wrong. So looking forward with this movement in cash rates and this higher inflationary scenario with a lot of pressure across the market, these lower quality businesses are no longer going to be supported. That's clear. And there's some facts behind it here. So in the current market, the highest dividend yielding stocks come with the highest amount of capital at risk. This is the performance of the top 10 dividend yielding stocks at 31 December, if we'd bought them and held them through to today, this last 6-month journey, they've lost what appeared to be a high dividend and a lot more in the form of capital. So the share price has gone down by more than the dividend over this 6-month window. This dynamic, we believe, is set to continue into the second half of this calendar year and into 2024. We're approaching another red zone, and the last red zone in terms of dividend risk was during COVID, and it's for a couple of reasons, and they're pretty simple. We all know that corporate debt costs have gone up materially, so companies that employ a lot of debt and need to access debt to grow their earnings and dividends, that strategy is just not sustainable as we look forward, and so we see dividend and earnings risks across a lot of highly indebted businesses across Australia. Secondly, volatile commodity prices. We know that the major iron ore companies are printing lower dividends off the back of lower payout ratios due to the iron ore price, which has pulled back since 2022. And a lot of household budgets are starting to think about budgeting, saving. So discretionary areas of the market that what are paying appears to be high yields are under a lot of pressure. So when we're talking about income investing at Solaris, we're talking about investing in sustainable and growing yields. We're focused on the capital, but it's as much about avoiding the dividend traps. And you can't just passively invest in these high-yielding stocks because they're going to lose capital. And here's 3 examples. Stocks that we've avoided over the last 6 months, despite offering what appeared to be a really high yield at the start of the period. I put in Scentre Group as an example of a REIT. Everyone knows Westfield. It's got a very high level of debt, which leaves zero margin of safety for equity investors. We think that there's dividend risks embedded within Scentre Group and no margin of safety. But the same is to be said for quite a few other real estate trusts like Cromwell that have got very high levels of debt and unsustainable dividends. Whitehaven Coal is one. It touches on our process. We, out of those top 10 stocks on the previous chart, the top 3 of them were coal stocks. In our long-short fund, we'd been short 2 of them because we had such a high conviction view on the earnings, the dividends and the share price that was at risk from 31 December. So we're not investing in these stocks with unsustainable dividends, despite offering a very high yield. And the last one is retail, so Premier Investments. Back at 31 December, looked to be a high yield. They've even offered a special dividend, which is really enticing for income investors, but we've been avoiding it due to our focus on capital and the earnings and margin risks embedded with Premier. So all 3 have lost their dividends and more. We're forecasting over 250 stocks at Solaris, and when we're thinking about income investing, we're firstly focusing on capital growth, and then we're thinking about a sustainable and healthy level of yield rather than a very high yield. So why Solaris? We have a focus on the total return outcome for the investors in our fund. Retirees, zero tax rate payers, we're focused on the income, the franking, and the capital growth. So a couple of stock examples in the portfolio I'd like to point out that really highlight our differentiated approach. And the first of which is Suncorp. So great Queensland business. It's paying an 8.1% gross yield, and I talked about it back here in February. It's a business which we see has the potential to grow that yield and has multiple catalysts in terms of the share price performance coming up. Anyone that has an AMI, AAMI or GIO insurance policy, you're going to be surprised again by the premium rate increases that are coming through. So there's up to 50% increases in Suncorp's premiums, which are supporting the earnings and dividend outlook. So a lot of pricing power and a stock we really like from an income perspective and the capital growth that has the potential to follow. Macquarie's got a 5.7% gross yield. It's a very high quality business that we've held in our income fund since inception in 2016. And it's not a high yield, but we call it a high quality yield, in that it has the potential to grow over the next 1, 3 and 5 year windows based on our forecast. And you may think we're crazy talking about income and franking when I'm putting CSL up here, which only has a 1.7% gross yield. But it is a business that is very powerful and is reinvesting a large amount of its earnings at high rates of return. So we see CSL with the potential to grow its earnings by over 10% per annum over the next 5 years. And when we take a step back, we go back to that photo of me in 20 years' time, I'm not just thinking about income, I'm also thinking about capital growth. And it's a core portfolio of stocks that we have in our income fund that have the potential to deliver material capital growth over a 3 and 5 and 7 and 10-year investment horizon. So they really deserve a core place in our income portfolio. This is quite unique, we believe, across the market, this focus on capital growth and income. And we've delivered a great outcome since inception, an 8.7% gross yield, and we've grown that capital over time. So today I've touched on why we believe equities are a really powerful asset class to consider for retirement income portfolios, the benefit of capital growth over longer periods of time by investing in productive companies with the added benefit of franking, and why active management is critical and that you can't just invest passively in high-yielding stocks. You're going to get burned on capital, particularly in this environment. And our unique approach at Solaris, our focus on income, franking, and capital growth over longer periods of time. So thanks for your time today, and we'd love to have a chat about the fund in more detail after this. Thanks for your time today.
Thanks, buddy. Don't go.